it's funny. I was talking to my partner about this, and in the late '80s, he had an informational advantage that he could monetize by helping clients access public markets. Like, no one knew how to invest in stocks. How do you do that? Well, you got to call your broker, who has a quotron that they've shared with 10 other people that's on a spinner, and they can pull up a quote and figure out how to get you shares of IBM if you want to buy them. Now, if you want IBM, you just pull out your phone, you press a couple buttons, and all of a sudden you own shares of IBM. Anybody can do that. We're about at that same stage with access to private markets. Private markets, as I said, have just recently been democratized. So there are funds available out there, but you might not hear about them. Why? Because maybe you're not the right definition of an accredited investor or qualified client or qualified purchaser. So you're not going to hear about them until you get to that designation. Maybe the financial advisor you're working with is just unfamiliar with these types of investments. Maybe if they are familiar, they haven't taken the time to research what defines a good investment versus a bad investment. What are complementary investments? How do you make up a portfolio of these investments? How do you monitor and evaluate them on a go-forward basis? So I would say we're in that same situation now with private markets and alternative investments that my partner was in 30 years ago with public investments. We have we're information gatherers on behalf of clients, and that's how we add some value. So you really do have to know not only your client's balance sheet, but their tolerance for illiquidity, their appetite for maybe more complex tax reporting, their willingness to have lumpiness in cash flows. All of that goes into making decisions on what alternative investments may or may not be appropriate.